What do we know about this, given that he hasn't shared sentiment about this particular stock since about May this year?
Yeah, I think it's quite illuminating, Heidi. I think it does tell you a lot about the thinking around overvaluations generally, but specifically, first of all, in Apple. I mean, a 25% reduction is obviously material. It's a continuation of, the vibes that we've heard already, that he's talked about the tax implications of why that's happening. And it's a material decline, of course, in their overall holding in Apple. We did hear from the company itself, of course, last week. Apple said they're projecting, low to mid-single digit growth in the December quarter. So that is notable that this is coming around the time that the company itself is guiding towards those kind of numbers. And analysts, I think, in their reflection and the way that the news has been taken, is that it kind of makes sense for Berkshire to be lightening their position as they have done here. So yeah, continuation of the theme really, but clearly quite a big pullback still. So it shows you some of the sentiment around some of those big tech names that big investors are withdrawing from in some part.
How about Berkshire's position in equities more generally?
Yeah, well, Paul, overall, it's a continuation of a theme of dialing back the equity exposure. And you singled out that cash pile number, which now stands at $325 billion. It speaks to really a sentiment of them not finding an overriding number of opportunities to deploy their cash. And of course, the 35 billion reduction in equity position this year is at a faster pace building on this year than we saw last year. So clearly that, coupled with the fact that they're not buying back their own stock at the moment, does give you some kind of indication as to the sense of wanting to keep that cash pile very, very strong, still waiting and wanting to be nimble to opportunities, but just at the margin there, dialing back some risk in equities.